What's going on with the stock market? Why has the stock market been so volatile? I'm going to break it down here on this video. Also provide an update on Tesla and Enphase. We always talk about the macro and how it's important, how it will impact stocks, especially in the short term to midterm. We talk not only about, of course, earnings, that's going to be critical, and we're in earnings season right now, but also the macro environment and the geopolitics. Those things really will drive stocks different directions. Now, earlier this week, we talked about how Jerome Powell was going to be talking yesterday on Thursday, and he did exactly that, and it was pretty hawkish. Powell says inflation is still too high and lower economic growth is likely needed to bring it down. The stock market is never going to want to hear that. You have to remember that when we talk about the stock market, the large majority of the money invested is going to be institutional investors. Now, not all institutional investors, but the large majority are really focused on 6 months and 12 months, not 6 years and 12 years. So when you see price targets and price targets revised down, they're thinking about a 6 and a 12-month price target. Now, if you're watching this, you might be a long-term investor and you might be thinking 6 and 12 years, and it's a little bit different story. I've been investing since the late 1990s. I've seen all the ups and downs since then over a 25-year period. And I can tell you that my wealth was created by buying stocks when really no one else wanted to. Wealth is created in bear markets. It's not realized until you actually hit a bull market. That's where wealth is going to be created. In bear markets, in bull markets, it's when you take some profits, you stack those gains, and you accumulate wealth. So Powell acknowledged recent signs of cooling inflation. Well, that's a positive, but said Thursday the central bank would be resolute in its commitment to its 2% mandate. So the Fed wants to bring inflation to 2% by any means necessary. If that means people losing jobs, the economy goes into recession, it seems like it doesn't really matter as long as inflation is at 2%. You could literally see the algos kicking in and stocks selling off as Jerome Powell spoke yesterday. A quote here, inflation's still too high, and a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal of that 2%. We cannot yet know how long these lower readings will persist or where inflation will settle over coming quarters. He also says the path is likely to be bumpy and take some time. My colleagues and I are united to our commitment to bringing inflation down to 2%. One last quote, this is the big one. Does it feel like policy is too tight right now? I would have to say no. Still, he noted that higher interest rates are difficult for everybody. So yeah, it's painful, but it is what it is. We've got to do what we got to do to get inflation to 2%. Now, for those that have been watching the channel consistently, you're paying attention, you're in Patreon Discord, you're listening to live streams, you're listening to Chart Day, you're reading my commentary in Discord. You know that I've been telling you there are plenty of macro risks to be worried about here, especially when the market ripped up here in July. The market was still going higher, and I was telling people you have to be careful here. Now, I like to talk about stocks that I like to buy. One thing you have to keep in mind is when I'm buying stocks, I generally DCA, and I aggressively DCA. One example we'll get to later is Enphase. Now, we've talked about Enphase several times in the channel, and we talked about Enphase when it was closer to $150. Me personally, what I've told you is I wasn't going to buy the stock to $125 or less. Now, I've got 55 shares of Enphase. I'm looking for 2, maybe even 300 shares of Enphase. I have 55 shares. I bought a few more this morning. So right now, it's about 0.25% of my portfolio, and it's the cost basis of $115. I'm down 15%. So I'm down, what, $1,000 on a $1.5 million portfolio? I'm not sweating too much. Now, the problem is a lot of people come on YouTube and they want to buy just a handful of stocks and they're looking for quick wins. They're trying to YOLO. They're trying to get rich quick. So they watch a few videos. They're like, hey, Enphase was a $350 stock. I'm going to buy some at $150. It's going to go back to $300 and I'm going to be rich. When we talk about Enphase, we say it's more speculative growth. We say that interest rates definitely will impact a stock like Enphase and solar stocks in general. So Solar Edge came out last night and gave us some preliminary information, and it was pretty weak. It was pretty awful. Now, I'll talk more about that later, but what I want to point out right now, so specific stocks are impacted by the macro severely. You have cyclical stocks, you have stocks that are very interest rate sensitive. Solar stocks fit in that basket where they're very interest rate sensitive. Then when you think of just speculative stocks in general, any stock that's burning cash, that's not profitable, a high multiple valuation, something like, a SaaS name, those are going to be at risk to sell off harder when the overall market sells off. So when we say the market selling off, generally that means the S&P 500. So you're going to see more pressure. You might see the S&P down 1%, but if you have all spec stocks in your portfolio, you might be down 5 or 10%. That's why it's important to have a blueprint, build a portfolio that meets your needs and suitability, and not go too heavy on stocks like spec. We talk about 5 or 10% max spec and having a medley of stocks in there. So if you have a $100,000 portfolio, say you want 10% in spec, that's $10,000. You might have 10 to 20 stocks in that bucket. If you're managing that properly and you're buying some of these names, you're not doing too bad, especially if you're dollar cost averaging. Now, names like Tesla, we really haven't bought since it was below $150. I added a few shares here recently, retirement. Wanted to get 100 shares. I added 10 shares. Stock went down, and I was actually hoping for that. I bought some more shares this morning. I'm going to continue to add. We'll look at the chart. I'll show you some price areas, some target ranges for both Tesla and Enphase. So we do chart day every single Wednesday at 9 o'clock a.m. Eastern, Patreon Discord. If you see orange, that's a previous chart day. Yellow is going to be today's notes or today's chart day. Of course, today is not chart day. It's just a YouTube video, and I've got some notes in here from yesterday that I posted in Discord. Now, if you want to join us live every single Wednesday at 9 o'clock a.m. Eastern, check out patreon.com/firedupwealth. Now, on Wednesday, the technicals were looking decent, but we said macro is going to matter. We said earnings are going to matter. It's also going to matter what the Fed does, what Jerome Powell says. So obviously when Jerome Powell is very hawkish, the market's going to get spooked and it's going to sell off. So yesterday in Discord, I said we're going to probably retest that $350, $352 range that we saw earlier this month. And you can see looking at a chart in August, we hit 354. We got down to 351.38 here just, I don't know, a couple weeks ago. Looks like Wednesday, September 27th. So I guess about a month ago, because it's October 20th today, and now we're hovering, right around $354. Right in that magic area again, 354, 351, 354. So that's the line. We obviously broke past that here in late September. Basically, this is the line that we went to, $352. So we're kind of going to retest that range, that $352 to $354 range. The question is it going to break down and go lower? Now, I don't have a crystal ball, but I know if it does break down, one possible area to look for is this 200-day simple moving average. That's going to be closer to $337, $338. Now, the market just closed, and post-market, we're at $354.34, and that's going to wrap it up for the week. Let's switch gears to Tesla. Just reported earnings here a couple days ago. Non-GAAP EPS 66 cents. That missed by 7 cents. Revenue $23.35 billion. That missed by $790 million. The CapEx $2.46 billion versus $2.06 billion in Q2 2023. That free cash flow, looking again at 2Q 2023, $848 million versus $1 billion. A lot of these numbers are lower. Now, there were some positives on the earnings call, I thought, but when you look at it from an analyst perspective on Wall Street, there are a lot more negatives than positives. That's just simply a fact. Now, I personally was expecting a lot of this. The problem with Wall Street is oftentimes they're not really expecting it, it seems. And so when it happens, then you're going to see a sell-off. It's always interesting when you think of expectations. You say, oh, well, we missed earnings. This is based off analyst consensus estimates. And margins are getting squeezed. We knew that too. We've been talking about it for months and months. So look at total automotive revenues right at this top line. This goes back to Q3 of 2022 to current here. This is Q3 of 2023. So this is 19,625. This is in millions. Now on this far right, it's going to give you year over year. This is 5%. So positive 5%. Energy generation up 40%. You start looking at things like gross profit. This is down 22% year over year. Total GAAP gross margin down 719 basis points. Operating expenses up 43%. We knew that was coming because they overhauled some factories. Income from operations down 52%. Operating margin down 964 basis points. Adjusted EBITDA down 24%. Adjusted EBITDA margin down 706 basis points. You get the idea. This is a big one here. Free cash flow, negative 74% year over year. Cash and cash equivalents, this is 24% positive, so that's a good thing. So total revenue grew 9% year over year in Q3 to $23.4 billion. That's not the growth you want to see when the stock's trading at 65 PE on a 12-month trailing. Revenue was impacted by the following items: growth in vehicle deliveries, growth in other parts of the business, reduced average selling price. Prices are coming down. They're trying to bring prices down to sell more cars. Plus, Musk knows that the consumer has less money to spend. We're getting squeezed. We've got less disposable income. So we're trying to reduce the price of the cars so more people can still buy them and they can keep their numbers growing. They're also trying to build that, what we call a network effect. And we just got recent news. Toyota is now joining the Tesla charging standard, and it seems like pretty much everybody at this point has gone on board with using Tesla as the charging standard for electric vehicles. It also had a negative FX impact of about $0.4 billion. So profitability, Okay. Operating income decreased year over year to $1.83 billion in Q3, resulting in a 7.6% operating margin. That's lower than what Wall Street's going to want to see. This is a negative, guys. Let's just be realistic. Let's look at this as neutral investors. The year over year operating income was primarily impacted by the following items you can see on your screen. We talked about negative FX impact, growth in deliveries, lower cost per vehicle, lower IRA credit benefit, growth in regulatory credit sales, gross profit growth in energy generation and storage, and you can see the rest on your screen. So cash position right now increased sequentially by $3 billion to $26.1 billion. That's a positive, driven by financing activities of $2.3 billion and free cash flow of $0.8 billion. Okay, so you get this earnings call. Musk is a little bit pessimistic on the economy. Then Jerome Powell speaks. Then SolarEdge comes out with preliminary results that are pretty weak. And you mix those things together, you've got some problems, especially when you're thinking about this space. When you look at EVs and solar, they often do trade in lockstep together. So EV stocks in general sold off on the news. I mean, Lucid now under $5 a share. You saw a lot of the Chinese EV makers get crushed further on their stock price. So treasury yields were over 5%. I didn't mention that in the beginning, but that's obviously part of the driver. And the reason that treasury yields spike, Jerome Powell is hawkish, and more people are going to go buy treasuries. Treasury yields are going to spike. They spiked over 5%. Now, it's the first time since 2007, and that's why it's putting pressure on specific names, like we talked about in the beginning, like solar stocks, spec stocks, and so on. So Musk said on the earnings call, I'm worried about the high interest rate environment we're in, and said people buying cars are focused on how much their monthly payments will be. If interest rates remain high or if they go even higher, it's much harder for people to buy the car. And if Jerome Powell is saying that they're not done yet, basically giving us hints that they might raise rates even further, that's going to have even more impacts on the consumer. And as we talk about, the consumer is 68% of GDP. You take away that disposable income, you take away that spending, and now you're going to go into recession. And that's why the stock market's selling off, a combination of all these factors. And Musk later on the call said, I just can't emphasize enough how important cost is. We have to make our products more affordable so more people can buy it. He said bringing the cost of Tesla cars down was akin to Game of Thrones, but pennies. So one of the positives that really spun into a negative, Cybertruck production remains on track for later this year with first deliveries scheduled for November 30th at Giga, Texas. Well, that sounds like a positive. Except then Musk said on the call that Tesla dug its own grave with Cybertruck. So Musk on the earnings call, quote, we dug our own grave with the Cybertruck. And special products that come along once in a long while are just incredibly difficult to bring to market to reach volume. It's fundamental to the nature of the newness. So this is basically saying it's going to be very expensive and difficult to create these Cybertrucks. And so great, we're rolling out Cybertrucks, but what are the margins going to look like for that? And how much expense is really baked into that? And what if they don't sell enough Cybertrucks? And then analysts scramble and they say, there's a headline here, I'll show you. Here it is. This is a title from Fortune. Elon Musk lost $30 billion in just over 2 days as the market realized Tesla may not be a tech giant, but a struggling car company. So here's that narrative again. There's another article I saw, Tesla has reached its prime, and so on and so on. Here's a tweet from Sawyer Merritt, and this is from Morgan Stanley, Adam Jonas. A new note, this is a quote. We see Tesla's incrementally negative outlook as a sign the company wants to err on the side of caution to protect the house at a time of elevated macro, consumer, and geopolitical risk. This is why it's important to understand the macro. Everything ties back, especially when you're thinking about Wall Street analysts and really the price action of stocks. At various times in Tesla's history, the company's strategy has swung from offensive to defensive. The current tone has clearly shifted to the latter. While the reset may hurt shares near term, we believe that this may prove to be the right strategy for the company and its shareholders, its stakeholders over the long term. So demand is slowing. There's all these problems going on, but basically this is saying that Tesla is still positioned well in the future and they're doing what they have to do to get through the short-term storm. Here's another tweet from Gary Black. I like to show different perspectives. It's good to get different perspectives, whether you agree with them or not. Why did Tesla conference call miss the mark so badly with investors? Tesla investors losing confidence in Tesla's long-term growth trajectory and fears of further price cuts in the short term. Macro factors are a minor factor. He's saying that macro factors are a minor factor that Elon overplayed on the earnings call. I don't know if you agree with that or not. Drop a comment, let me know. Tesla EV monthly payments are now lower than they were 12 to 18 months ago, given 20% lower prices. That might be true, but okay, so the payments are lower, and that makes sense. So what he's basically saying, like the macro is impacted, but Teslas are way cheaper now than they were, 18 months ago before they started actually reducing the prices. Now, it's a little bit more complicated than that. If you're getting squeezed from every angle, your rent's higher, your mortgage is higher, your payments are higher, your gas, everything is higher. Your student loans just kicked back in. Part of it, obviously, is disposable income. The other part of it is going to be sentiment. If a person is afraid about the future, about his or her job, they're not going to go splurge on a Tesla vehicle. So as economic conditions deteriorate, the consumer is going to start to deteriorate as well. And so even though you can make the argument, yeah, the payment's less, what about all the other areas they're being squeezed in? And then more importantly, what's the overall psychology of that buyer, of that consumer? What's the sentiment? If I'm afraid I'm going to lose my job and I'm afraid things are going to get worse and worse, I'm not going to go buy a new car. It doesn't matter if it's a Tesla necessarily or not. And this is very similar to the cycle we saw in SaaS, where certain SaaS companies, the majority of them, were telling us that they were getting pushback and trying to get deals closed. And those deals weren't going away. They were just getting pushed further down the line. It's kind of the same thing, but instead of B2B, it's going to be B2C, right? So Tesla's selling to you, the consumer. You might say, hey, I'm going to kind of hold back on my budget just to wait and ride the storm out, see how things turn out here before I do anything crazy and buy a new car. Here's another article on Seeking Alpha. Tesla falls as investors adjust to new margin realities. You can see here the short interest is 3.04%. So that's not too bad at this point on Tesla. And we closed at about $212 today, $211.99. I'll go through a chart here in a little bit. So Tesla obviously sold off. Investors eyed the sizable drop in margins in Q3, both sequentially and from a year ago. The electric vehicle makers saw margins decline during the quarter due to lower model prices and operating expense pressure from scaling up factories and increased AI spending. Now think about this for 1 second. If I'm scaling up my factories and I'm investing in AI technology, as a growth investor, if I'm investing in a company for 5 years or more, I'm excited about Tesla investing in being able to build more cars more efficiently and have an AI technology. In the short term, Wall Street does not care. Wall Street, again, is focused on 6 months and 12 months, not 6 years and 12 years. Tesla is doing what it has to do to be where it wants to be later. And Tesla ultimately can't control the fact that interest rates are high and that the economy is starting to worsen. So we got some mixed analyst reviews on this. Wedbush Securities analyst Dan Ives said in the near term, there are clearly challenges to navigate as the margin and volume story is tight balancing act. The firm kept an outperform rating on Tesla, lowered the price target from $350 to $310. Bank of America reiterated a neutral rating on Tesla, talked about balancing near-term risks from the broader macro, again, going back to the macro, increasing competition, and the impact of recent price cuts against efforts to reduce costs, et cetera, et cetera. So year-over-year revenue growth, 28% for Tesla, the forward revenue, 31%. So a pretty strong grade here, B plus on the growth. Now, valuation-wise, this is going to be expensive. And this is where it goes back to, is this a tech company or is it a car company? So the people that think it's a tech company, they are willing to pay a 60 PE ratio. And the ones that want to compare it to Ford and GM, they think it's, 6x overvalued. So the PE gap, 12 months trailing, 71. The Ford, 83. You can look at the numbers. It's not a cheap stock. So it's important at least to have an idea if you're buying this stock or if you own the stock. I like Tesla. I'm a bull on Tesla. But if you look at basic metrics like this, of course, if you're investing in growth, you're generally going to pay a premium. The question is it worth 70 or 80, PE ratio or not? You look at price to sales, 7.18. That's Ford. Current here, 7.27. Price to book is a 13.08. So previous chart day, again, guys, you see orange. It's a previous chart day. Yellow is today's chart day. I've got nothing in yellow. I'm just going to talk through it. Recently on chart day, we said downside possibilities, 228, 214, 202, and 188. And this was when the stock was over $250 a share. Now, again, if this information is helpful, we do live streams every Monday, Wednesday, and Friday. Wednesday's chart day. Mondays and Fridays, we do live stream podcasts. And generally, it's going to be a stock market update similar to this one, as well as some real talk commentary. And those Monday and Friday videos, they're audio podcasts only. Wednesday is going to be a live stream video. Now, looking at Tesla's chart, again, we closed at about $212 a share. The S3 on this is just above $210. It's at $210.19. If you're not familiar, these are Fibonacci pivot points on TradingView, and this is a Fibonacci retracement, this ribbon. So you're getting basically to the support 3, the S3 line. And we're also at the 200-day moving average. I said in Discord yesterday, I believe it was, or after earnings, I said if I were building out a position in Tesla, I would look first at $210, then $200, then $190. So right in this area today, it did get down to 210 and change. I did buy some at 210 change in my retirement account. Your next area is going to be down here around $200, and then something around 190. The previous S3 is 191, and that's going to give you some possibilities for dollar cost averaging. There's no guarantee it's going to go this low, and there's no guarantee that it can't go lower. It's just possibilities on a chart. If analysts keep revising and lowering price targets, you could see more pressure, and you could see it below $190. I could easily see this, 175, maybe even lower. It's hard to say. You're either a bull or a bear in Tesla. Either you're going to be willing to pay $200 a share for it, or you wouldn't touch it unless it were, $50 a share or whatever the story is for the bears. Okay, so what's going on with Enphase and other solar stocks? That whole basket's getting crushed today. Solar stocks tumbled a 3-year low as SolarEdge drops nearly 30% on demand warning. Now, you've got two things working against you. SolarEdge came out and basically lowered their guidance. Secondly, at the same time, Jerome Powell, the same exact day, came out, was very hawkish, kind of hinting to the fact the Fed's possibly going to raise rates more and make things worse than they already are. And then at the same time, Treasury yields spike over 5%. So you've got 10-year Treasuries that are over 5% for the first time since 2007. And at the same time, you've got solar stocks tumbling to 3-year lows. And it makes sense. If you look under the hood, it does make sense. Especially the timing, it's a perfect storm of all those things at one time. Now, we have said many times, don't be surprised if you see Enphase below $100 a share. We talk about the macro, how it's interest rate sensitive, and if Treasury yields continue to go higher, if they miss earnings, you could see it under $100. And so I've been buying that stock very slowly. I have a very small position. My cost basis right now is about $115 after this morning's buy. I bought some at $97 and change. So if you look at the Invesco Solar ETF, that's the TAN, it was down 6.57%. That's a significant move for an ETF. Sunrun down 5.7%, Sonova down 8.9%, Enphase was down 15%. Enphase and SolarEdge, they're going to have a lot more overlap than some of these other names, but SolarEdge was down 28.2%. And I don't own that stock. I know a lot of people ask me about it. I just personally prefer Enphase. So SolarEdge said revenue, gross margins, and operating income in the third quarter would be below what Wall Street is expecting, and added that it estimates significantly lower revenue in the fourth quarter. This is big right here. The CEO cited substantial unexpected cancellations and pushouts of existing backlogs from the company's European distributors due to high inventories and slow installation rates. Consumers are getting squeezed. They've got less money to go buy a Tesla. They've got less money to install a solar system on their home. Then on top of that, of course, winter's coming, and you're going to have way less installations in Europe during winter than you are in the summer. Installation rates for the third quarter were also much slower at the end of summer and in September, where traditionally there had been a rise in installation rates. Usually people install before you basically go into the winter months to get it done. So we're seeing a slowdown at the end of summer in September when historically it's been busy. This comes back to the consumer. It comes back to how much money do people have to spend. Prices going up, interest rates going up, less disposable income to go out and buy stuff that might just be a want versus a need. So just how bad were these numbers that SolarEdge came out with? Now sees Q3 revenues of $720 to $730 million compared to previous guidance of $880 to $920 million, an analyst consensus of $910 million. That's a big miss right there. Company also forecasts non-GAAP operating income of $12 million to $31 million, the big range, and non-GAAP gross margin of 20.1% to 21.1% compared to guidance of $115 to $135 million. Read that again. So forecasting non-GAAP operating income of $12 million to $31 million. $12 million to $31 million versus $115 to $135 million. And gross margins 20 to 21%. But previously, the expectation, 28 to 31%. So if you go from 31% to 20%, that's a big difference, right? Next, I'm going to cover a chart of Enphase to show you where the stock could possibly go. If you're new here, make sure you subscribe to the channel, click that bell for notifications. And if this video is helpful, please do me a favor, drop me a like and drop me a comment. I'd also love to see you in our Discord. And there's a free trial right now for Elite. Head to patreon.com/firedupwealth and check it out. Now, the reason I keep all the comments on these charts in orange is exactly for this reason right here. And somebody asked me last night, you've been buying this heavily since $150 a share, blah, blah, blah. That's not true. And you can go back and see Go to the very bottom. When this was $350, there were people that were buying this stock at $300 saying it was going to $700. I said I would not touch it unless it was $200 or less. And I said, patient pays off. I've been waiting to buy in Maine. And then I said 150. So when I got to $200, I was saying $150 or less DCA. And then I changed my personal entry point to 125. And there's no guarantee that it's going to go to 125. We've also said several times, up here you can see under $100 possible, which would be a pound the table. And I do think that it could still go lower, but I think if I'm looking 5 years out, if I'm buying in that $100 range, if it goes to 75 and I'm buying it at 100, at 90, 80, 75, if I've got a 90 or $100 cost basis and I'm holding the stock for 5 years, I think it's going to be a strong opportunity. In the short term, it's an absolute, train wreck when you look at the overall macro. The other thing you have to keep in mind, and Zach pointed this out in Discord earlier today. So I posted this right here. Enphase price target lowered to $84 at Bank of America. And Zach says, it's amazing that these funds basically come out and they change price targets without actually knowing the earnings. And I agree with Zach. I mean, essentially they're saying, okay, because SolarEdge is having problems in Europe, Enphase is going to have problems too. A couple things to note on that. Number one, Enphase does not have nearly as much European exposure as SolarEdge. Now, the way analysts are going to spin that is, well, Enphase's primary growth story was about Europe. And so now that growth story is going away. But it's possible that when Enphase reports earnings next week, that those numbers aren't nearly as bad as what SolarEdge showed us yesterday. Now, with that said, the stock can go lower. And if analysts are going to lower price targets to $85, could you see the stock at 75 bucks? The answer is yes. And if you're buying a stock, of course, it's on you. What you buy is up to you. I try to provide information and be as neutral as I can and share information to help you with your decisions. So with this stock, I was preferring 125 and I was patient. It actually got down to 119. I bought some shares. I was sitting on 55 shares as of yesterday, 55 shares at $119 cost basis. And then I added some this morning and now I'm sitting at, like I said, 0.25% of my portfolio, very small, and $115 cost basis. So right now the stock is just under $100. You're looking at a 15 or 16%, loss on that. But I'm looking to DCA and add more shares. And so when I'm looking at this chart right now and I'm trying to say, where could the stock go next? Well, we've broken through all the supports. We're under all the moving averages. We're at the bottom of the retracement. So we're really in no man's land. Now, if you look at the growth of Enphase, we've got an A rating here, 61% year over year. The forward has been revised down to 29.5%. But these numbers are very strong. This is a profitable company. Right now, it's showing a PE gap, TTM 29, and the forward is a 34. On the PE ratio, if you look at non-gap, you've got a 20. If you look at the gap, so the gap TTM is a 29 and the forward is a 34. So we're expecting basically some slowdown here. And that's why the stock is selling off. But you can look at this and say, all right, is this stock expensive? In the short term, the stock's probably going to continue to have volatility. You've got earnings. You probably have to see what's going to happen with earnings. I personally like the dollar cost average, nibble a little bit here and there. If it goes lower in earnings, I'm going to buy some more. If you look at the numbers, guys, though, this is really strong. Analyst ratings, buy, Wall Street's a buy, the quant is a sell. It's basically just really bad sentiment. The technicals of the stock are poor. This is the time where I generally like to buy. And if I have a long-term mindset, I make money. If you're new here, make sure you subscribe to the channel. Click that bell for notifications. If this video is helpful, please drop me a like and a comment. Have a great rest of your day. Take care.